Hello, Sharon.
How you all doing? Hey, Pat, how you doing? So Pat, thanks for, I know this is not, the timing isn't perfect today for you with the session, but thank you for your cooperation on it.
Sure.
And welcome to all the witnesses, and we will start in a matter of about 30 seconds. So thanks for all arriving on time. Good to some of you I've met, and one of you at least has been to my morning coffee. And Commissioner, nice to see you again and testifying, and so thank you all. And the Banking, Housing, Urban Affairs Committee will come to order. This hearing is in the virtual format. A few reminders as you begin. Sorry, those of you that have to hear this every hearing. Once you start speaking, there'll be a slight delay before you're displayed on the screen. To minimize background noise, please click the mute button until it is your turn to speak or to ask questions. You should all have a box on your screens labeled clock that will show how much time is remaining. For witnesses, you'll have 5 minutes for opening statements. For senators, the 5-minute clock still applies to your questions. At 30 seconds remaining for your statements and questions, you will hear a bell ring to remind you your time is almost expired. It will ring again when your time has expired. If there's a technology issue, we'll simply move to the next witness or the next senator until it is resolved. Fortunately, because of Cameron and Charlie's work, we rarely have technical problems, but one never knows. To simplify the speaking order process, Senator Toomey and I have agreed to go by seniority for this hearing. Last February, as the world came to the collective realization that we were confronting a global pandemic, the U.S. stock market suffered its fastest drop in history, plummeting, as we recall, 34% in 33 days. This was followed by the fastest stock market rebound in history, recovering all of these losses by mid-August. It was clear what most working people had suspected for a long time. The stock market is detached from the economy and the reality of most Americans' lives. The coronavirus was spreading, widespread testing wasn't available. We didn't know if the hope of a vaccine was months or, for that matter, years away. Unemployment surged, reaching 23 million jobs lost by April. Almost a year later, only about half those jobs have been recovered. Families and small businesses had no certainty about what their lives would look like in a few weeks, let alone next year. But the stock market continued to go up and up. Those lucky enough to own investments reaped the profit. To some, this looked like a new development, but to millions of Americans, to millions of workers who've watched the stock market reach new heights while their own paychecks never kept up, it looked pretty familiar. Families haven't been too surprised by the state of affairs. A whole lot of them never recovered from foreclosure or from losing their savings during the last crisis, but they watched Wall Street pocket its bailout and go on to record highs just a few short years later. That's because when you look at who truly benefits, it's clear that the stock market's gains funnel wealth to a tiny sliver of people, often at the direct expense of American workers. We discussed this last week in our hearing, Wall Street versus workers. According to Federal Reserve data, the wealthiest 1% hold 53% of stock in mutual fund investments. The bottom 90% own less than 12%. The bottom 90% own less than 12%. Between workplace retirement accounts and personal investments, about half of American households have at least one financial account tied to the market, but only 1 in 6 directly own stocks. None of this reflects the actual makeup of the country. Only 31% of Black families, 28% of Hispanic families own any stock investment. The wealthy are far more likely to have these accounts, of course, than middle-class families, who in turn are far more likely to be in the market than working-class families or poor families. So when the stock market soars, most people barely notice. They're trying to just keep up with the cost of living within their paychecks. In recent years, the growth of fintech and financial services has given rise to trading platforms that offer free stock trades. Firms like Robinhood and others claim to democratize stock trading with flashing marketing and easy to use features. And in one sense, it worked. They attract millions of customers, many of them young and new to investing. The frenzied stock trading this January, when shares of Gamestop went from $18 to over $400 in a matter of weeks, showed how millions of retail investors could engage with each other and create a sort of sensation. But it also lays bare serious risks. There are real people who get caught up in the frenzy who suffered real consequences. If the people who are busy working and watching their kids and living their lives can't make sense of the stock market's booms and busts, they'll continue to lose faith in the market. And hedge funds and insiders will continue to reap the vast majority of the profit. That's really bad for everyone in the long run. Robinhood tried to blame its decision to cut off its customers from being able to purchase GameStop and other stocks on industry-wide standards for processing stock purchases. Of course, the SEC and others should examine and consider how to reduce risk in the financial system by cutting the time it takes to complete stock purchases. Everyone would benefit from that. But it's become clear that firms like Robinhood were founded on a model that exploits small investors by encouraging fast and loose trading and then sells their trade to big market players. In a few short years, Robinhood violated the law, failed to respond to customers when they needed help, and when it got in trouble, cut off customers to save itself. Robinhood attracted new customers to investing, encouraged them to trade, profited off them, then broke their trust precisely when they needed the company to have their backs. It's also obvious that the David versus Goliath story, to mix metaphors perhaps, we first heard in January was not the whole picture. Well-funded, sophisticated hedge funds made big profits alongside the people trading at home. We know they always had better access and information than any of us ever will. No one thinks that's fair. Some have tried to blame small-time investors. They scold people just trying to make some extra money in the worst job market we've seen in most of our lifetimes. Because of the Robinhood business model and other reasons, we've all learned the new term gamification. But let's be clear, we've seen Wall Street treat the market as a game for decades, a game they always win at the expense of pretty much everyone else. Wall Street's never been friendly to the little guy. Surely this time is no different. Yes, some regular people have had success, but fundamentally the system is set up to funnel more wealth to the already wealthy. Just like in Las Vegas, the house always wins. The economy and the market should work for everyone, not just the well-connected. They should reflect the economy we all want, with broadly shared prosperity and a growing middle class that all workers have the opportunity to join. When that happens, people have confidence the markets can actually work for them, not just for Wall Street. We'll see more Americans save and invest for the future. This hearing will examine not only the volatile activity in a dozen stocks early this year, but also the practices that encourage that activity. We'll see how it affects our economy in the long term. We'll see who benefits and who loses from this tech-induced stock market volatility. I look forward to the testimony from all five of our witnesses. Senator Toomey.
Thank you, Chairman Brown, and welcome to all of our witnesses. This January's volatility in the stock market understandably captured everybody's attention. We saw extraordinary trading volumes in GameStop and other stocks, and we also saw some brokers limit stock purchases during this period of volatility. So it's entirely appropriate to examine these events and try to understand what happened and whether any response is needed. However, I urge my colleagues and regulators to avoid any knee-jerk reaction to impose unnecessary restrictions and burdens on investors. We have yet to see any evidence of wrongdoing or that the regulatory regime failed to function as intended, and Congress and regulators should avoid new laws and regulations that could end up limiting investors' access to and choices in the stock market. One reason to tread cautiously is that new developments have made it a great time to be a retail investor. Today, a person of modest means can invest in the stock market at zero or minimal cost. Two developments particularly stand out: the zero commission trading platforms with no minimum account balance required, and a user-friendly trading technology such as mobile apps. Zero commission trading is the culmination of a decline in investor costs since the SEC abolished fixed commissions in 1975 and forced brokers to compete against each other. In the 80s and 90s, it could cost you close to $100 to buy several $1,000s worth of stock. By the 2000s, online trading sites offered lower costs, but they could still cost you $30 for a trade. Competition from market makers allows brokers, under their best execution obligation, to obtain a better price for investors than current market price, even after receiving a payment for order flow, and they can charge zero to investors. Similarly, new technology like app-based trading platforms make it easier to access the market, including buying through fractional shares. And it's not just Robinhood attracting new investors. The Wall Street Journal reported that 2020, despite the volatility, was a record year for new individual accounts. And these developments have, of course, contributed to broader investment in the stock market. According to the Federal Reserve, in 1989, less than 1/3 of U.S. households owned stocks. 3 decades later, in 2019, a majority of American households did. And the most rapid growth is among low and middle income households. And let's not forget about the millions of others, including police officers, firefighters, teachers, and other workers indirectly invested through pension funds. This allows everyone to share in the tremendous wealth gains generated by the stock market, which used to be available only to wealthy individuals and institutional investors. Despite these positive developments, some see the state of retail investing only in negative terms. Rather than celebrating the fact that it's cheaper and easier for average Americans to invest in the stock market, some claim that the market is somehow rigged against retail investors. So, to my colleagues who say that, I'd like to hear why they believe that. Does the retail investor not receive dividends like institutional investors do? Is the retail investor not entitled to best execution on trades like institutional investors? When a stock goes up in value, does the value of a retail investor's share not go up like wealthy individuals? Of course, the answer to all of these questions is obviously no. And if the market is rigged, then why did some hedge funds lose their shirts shorting GameStop while some retail investors hit pay dirt buying it? I'm also incredulous at the idea that it somehow hurts retail investors to have access to investing technologies that are inexpensive and pleasant and easy to use. Retail investing doesn't need to be expensive and miserable and difficult to experience, nor should we want it to be. I'd like to see more U.S. households have the opportunity to benefit from the financial gains that are available through the stock market. Your average American doesn't need big government coming in to limit her access to and choices in the stock market. The fact is, risk is a fundamental part of investing. All investors, whether they are small retail investors or big hedge funds, can gain or lose money by investing. But what we know is for sure, over time, long-term investors investing in U.S. stocks, it's the exact opposite of going to the casino. Investors win, and when you go to the casino, you lose. Investors in GameStop and a few other stocks took a lot of risk, but they represent a very, very small fraction of retail investors. And investors should understand that if they make a very risky investment, they might lose money. Those who bought GameStop at its high very likely lost money. I certainly hope they didn't invest money they couldn't afford to lose, but it's not the government's job to tell people which stocks they can and which they cannot buy. In my view, there is one action that regulators should pursue, and Chairman Brown alluded to this, and that's to finish the work that it started in 2004 for a faster settlement cycle, including same-day cycle or maybe even real-time settlement. A faster settlement cycle will reduce risks for clearing agencies because there'll be fewer unsettled trades and a reduced time period of exposure. And a faster settlement cycle will also require less collateral for clearing agencies, which may reduce margin charges and other fees that are inevitably passed on to investors. When the SEC moved to T+2 back in 2017, the SEC said it wanted to make settlement even faster. And last month, Ranking Member McHenry from the House and I wrote to the SEC asking that they follow through on this longstanding objective. Let me close by just repeating, I think Congress and the regulators should tread very cautiously here. We should want to make sure that all parts of American society can participate and share in the gains of the stock market, and we should avoid taking actions that would undermine that goal. I look forward to today's testimony.
Thank you, Ranking Member Toomey. I'll introduce today's 5 witnesses. Gina Gale Fletcher, Professor of Law at the Duke University School of Law. Professor Fletcher is a scholar of complex financial instruments and market regulation. Her research focuses on the interplay of public regulations and private ordering, enhancing market stability and integrity. Welcome, Professor Fletcher. Rachel Rabashodi is the founder and chief executive officer of a Adesina social capital investment firm that seeks to serve as a bridge between financial markets and social justice movements. Welcome, Ms. Rabashodi. Dr. Teresa Ghilarducci is an economist, nationally recognized expert in retirement security. Dr. Ghilarducci holds the Irene and Bernard Schwartz Chair in Economic Policy Analysis in the Economics Department at the New School for Social Research. She directs the Schwartz Center for Economic Policy Analysis that focuses on economic policy research and outreach. Welcome, Dr. Ghilarducci. Commissioner Michael Pivovar is the executive director of the Milken Institute Center for Financial Markets. Commissioner Pivovar served as a commissioner at the U.S. Securities and Exchange Commission from August of 13 to July of 2018 and was acting chair from January to May 2017. Previously, he was the Republican chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs under Senators Crapo and Shelby. Welcome back, Commissioner Pivovar. And Andrew Vollmer is a senior affiliated scholar with the Mercatus Center at George Mason University. From 2014 to 2019, he taught securities regulation. He's the director of the John W. Glenn Jr. Law and Business Program at the University of Virginia School of Law. Prior to that, Mr. Vollmer was a partner in the securities litigation and enforcement practice at Wilmer Cutler, Pickering, Hale, and Dorr, and he also served as deputy general counsel at the SEC from 2006 to early 2009. Welcome, Mr. Vollmer, to our committee. Professor Fletcher, would you begin your testimony, please, for 5 minutes? Thank you.
Chairman Brown, Ranking Member Toomey, committee members, thank you for inviting me to testify today. I'm a professor of law at Duke University, where my research focuses on capital markets, financial regulation, and market manipulation. Our capital markets exist to channel investors' capital into its best uses, ideally funding companies to increase sales and create jobs, but also providing investors with reasonable returns, allowing them to save for retirement or to send their children to college. We're here today because we're seeing trading activity that seems to be divorced from this essential purpose. Since the start of the year, GameStop stock has gone through quite a bit of volatility. It started at a little under $20 a share at the beginning of the year, went up to $400, down to $40, and now as of yesterday was a little bit under $200 per share. All of this occurring over just a few weeks. As the company's stock price yo-yos back and forth, it is clearly not a good faith reflection of the fundamental value of a company with real stores, employees, and sales. The volatility in GameStop stock is just one of a growing number of examples of market price gyrations which seem to be impacting not only meme stocks, but also some penny stocks, special purpose acquisition companies, and even cryptocurrencies. Financial innovation has made it easier than ever for retail investors to trade more complex, leveraged, and risky assets than ever before. These developments have generally expanded retail participation in the markets, and in some ways, this is great. For example, a recent study has estimated that the racial gap in individual stock ownership has been halved in less than 5 years because of greater, lower-cost market access. However, recent market events have raised questions about the integrity and long-term stability of the markets. Now, while my written remarks cover several topics, I wish to highlight a few key points here. First, to the extent that asset values are subject to wild swings and are divorced from any semblance of fair market values, market participants will increasingly view the markets as rigged and unreliable. This will, in the long run, deter investment and harm our economy. Second, Congress and regulators should act to ensure that those who deliberately distort prices may be subject to regulatory or prosecutorial discipline. Third, Congress and regulators should address the incentives and market structures that have created the modern trading markets. This includes the proliferation of payment for order flow practices, the segmentation of retail orders, and the overall impact on trading costs for all investors, not just retail investors, but pension funds and other institutional investors. It's clear that retail brokers and market makers are making quite a bit of money from these practices, but it's also increasingly clear that retail and institutional investors are paying the price. Fourth, Congress and regulators should review whether and how investors should access complex leveraged products such as call options. Opening options trading accounts used to take weeks and still does with some brokers, yet it may take just a few minutes with other brokers. It should not take a suicide for us to realize that many investors in current markets do not fully comprehend the products that they are trading or the risks that they are taking. Fifth, finally, and perhaps most importantly, Congress and regulators must acknowledge that events like what we're seeing with GameStop and other assets are no longer outlier events, but are instead regular features of our current system. Unless action is taken, these events will continue to expand and evolve. This means that brokers need to be better prepared to stand behind their customers' risky trading, and to the extent brokers cannot, the answer ought not to lie with limiting retail participation, as seems to have happened recently when some broker-dealers suspended trading in highly volatile stocks. Additionally, regulators should consider shortening the settlement cycle so that fewer things can go wrong between the time of trade execution and when parties match up securities in cash. Today, it is easier, cheaper, and faster to trade more complex and leveraged financial products than ever before. This new market reality requires that we rethink the risks that accompany these developments, and in so doing, consider how to create a market that is fair, accessible, and stable for investors and the rest of the economy. Thank you.
Sorry, I was having trouble with the mute. Thank you, Professor Fletcher. Welcome, Ms. Robinhood. If you would speak for 5 minutes, thank you.
Mr. Chairman Brown, Ranking Member Toomey, and members of the committee, good morning, and thank you for inviting me to testify before this committee. It's my great honor. My name is Rachel Robichaux, and I hold leadership positions at 2 SEC-registered investment advisory firms. I'm the founder and CEO of Addisina Social Capital, where we manage an exchange-traded fund with the ticker symbol JSTC. It holds over 800 stocks and is accessible to everyday investors at a price of about $16 per share. I'm also the director of advocacy and engagement for Abacus Wealth Partners, which is a firm with $3.8 billion in assets under management, but no minimum account size for its clients. I serve hardworking, everyday Americans, so your constituents and my clients are the same people. I've worked in financial services for almost 22 years, so I take the long view of market events, and I've seen everything from the ill-fated dot-com boom of 2000 through the Great Recession and the most recent GameStop Robinhood episode in January and February. So I understand the players in the market, and in this most recent situation, there are really 3 groups for us to consider. First is the hedge funds. These are institutions that primarily manage money for the wealthy, accredited investors, and they're known for their risky strategies and high returns. 2, the Redditors, these tech-enabled young people who use commission-free trading and banded together to outwit the hedge funds they felt had an unfair advantage. Third, and these are the folks that I'm here for today, are the everyday Americans. Hardworking people with long-term retirement savings invested in the stock market. These people rely on government institutions and financial professionals to look out for them. When the GameStop Robinhood episode occurred in January, I was immediately reminded of the MIT blackjack team of the 1990s, when a group of students banded together to break the bank at several large casinos. They realized that if they worked together, they could win substantially more money than the average gambler. So using their math skills and their technology, they coordinated to quickly and strategically place large bets against the house. It's pretty easy to see the obvious similarities between the 2 situations. Like the MIT students, the Redditors in January were young, knowledgeable people with high appetites for risk who chose to collectively speculate by making quick bets against a larger player with a perceived advantage. On the other hand, like the casino owners, the hedge funds are these large institutions with specialized knowledge about the game who some say routinely use their size to tip the odds in their favor. What's not obvious, whether in the casino or in the stock market, is what the wealthy institutions and upstarts have in common. They're all fast-moving, high-risk speculators with more skills and tools than the average person. But there's a problem here for the stock market, which is supposed to be a place where a person can grow wealth by investing in companies that have good prospects. But when fast-moving, high-risk speculators dominate, we have a classic recipe for market disruptions. What we saw in January with GameStop and Robinhood is what we saw during the Great Recession, with Wall Street churning out subprime mortgage-backed securities. Market disruptions like this are a problem because, as stated by SEC commissioners in January, extreme stock price volatility has the potential to expose investors to rapid and severe losses and undermine market confidence. Now, unfortunately, this volatility doesn't impact everyone equally. And let me paint the picture of what the everyday investor experienced. Imagine a two-job household with a couple of kids, adults working hard to make ends meet and save enough for the future. They don't have a pension to fall back on for retirement because so few pensions now exist. They know Social Security benefits their parents receive aren't enough to cover most retirees' basic needs. And for several decades now, and this is key, the economy has only offered these savers historically low interest rates, which means that putting their money in low-risk savings accounts, CDs or bonds, barely makes them enough to keep up with inflation. This leaves investing in the stock market as their only option. It's the only way their savings can grow enough to provide for the future. So they're forced into the stock market casino with their life savings. And they're required to play against armies of sophisticated high-risk hedge funds and Redditors duking it out for dominance. For everyday Americans with smaller amounts that represent all they have to invest, sustaining significant losses or even the perception of losses is devastating. It makes them lose confidence and want to opt out altogether. But we know they can't leave the casino. As an investment professional who works for everyday investors, and as senators with these same people as your constituents, we must fix the system for them. We need to maintain fair, orderly, and efficient markets that serve as a reasonable place for the average American to invest their life savings. And we have a duty to protect these investors from the crossfire of fast-moving, high-risk speculators.
Thank you, Ms. Robichodi. Ms. Scalarducci.
Hello, thank you for inviting me, Chairman Brown and Ranking Member Toomey, and hello to members of the committee. I'm a professor of economics at the New School. I teach behavioral finance and labor markets. I also taught at the University of Notre Dame for 25 years. I received my PhD from UC Berkeley, and I've published 4 books on how workers acquire wealth. The latest one was Rescuing Retirement with my co-author, Tony James. I also am a court-appointed trustee overseeing $60 billion of the retiree healthcare trust fund money for auto workers. And that money is invested to last over 80 years. Now, as a professor, my office hours are typically quiet moments huddled over equations and numbers. But over the past few years, I've seen another trend. Students are coming to me bubbly because they want to know about trading on their phone app, Robinhood. Now, the young are told to buy stocks and they're told to hold them, but these students have absorbed the first point, but they haven't absorbed the second. Trading on Robinhood is a game, and it has psychologically powerful intermittent rewards. The trading is disconnected from long-term wealth accumulation. Phone apps make trading easy, and they are cheaper, and superficially, they seem to open the security markets to many more people. But trading apps do not produce wealth. I welcome today's hearings, seeking to protect retail stock buyers, seeking to protect my students, and I'm here to testify where Americans really get their wealth. So I am going to huddle over a few numbers in the next few minutes. And I draw my data from the gold-plated data from the University of Michigan, the Health and Retirement Survey. And I'm looking at households where people are still working, they're over the age 52, they've gone through their life cycle, they've accumulated their wealth, and we're going to take a snapshot of what their wealth looks like. So averages hide differences. So I'm going to report my numbers in terms of the bottom half of the wealth distribution, the middle class and the next 40%, and what the top 10% of the wealth distribution have. Now, you probably have already guessed that home equity the net wealth from their homes, and retirement wealth, including Social Security, are by far the largest component of wealth for everybody. They make up 88% of those components make up 88% of the wealth held by households in the lower half of the wealth distribution, 78% for the middle class, and 43% for those in the top 10%. I'm going to make a sidetrack note to note what Social Security means to households. I'm always surprised to see that Social Security is the most important source of wealth for households nearing retirement. In contrast to home equity, retirement health, wealth, and Social Security, directly owned stocks and bonds make up a small share of these households' wealth. The average is only 8%. Only 24% of older households own stocks directly outside of their retirement accounts. And that ownership, that 24%, is concentrated way at the top. Only 10% of people below the median own stocks directly, and it's a small amount. And less than a third of the middle class own stocks directly. And the wealthy, 70% of them do own stocks directly outside of their retirement wealth. But it is only 13% of their wealth. As Nobel Prize winner Robert Shiller, the economist, recent book just points out, stock trading feeds a narrative. It feeds a story about wealth. Stories about getting rich on stocks produce a fiction that stock trading creates wealth, when in fact retail investors fuel bubbles, as the witnesses have testified to. Defenders of Robinhood and widespread trading have purchased, because the COVID recession have produced wealthy people who have gotten wealth. Their gains heightens the fear of missing out, or FOMO. The reality is that most Americans are being left out because they don't have access to retirement accounts, which is where most of us own stocks. Retirement accounts are invested in diversified portfolios managed by institutional investors and professionals. It's those professionals that can handle the complex instruments for investments, and that's those professionals that accumulate savings, hard-earned savings by workers, and invest them in diversified portfolio. We need innovations in public policy to give more Americans access to what we know works. Professionally managed retirement coverage that allows everyone to benefit from the stock markets, the same way you and I do in the thrift savings plan, in private or public defined benefit plans, as Senator Toomey mentioned, the firefighters and the teachers, or in my plan, the Teachers Insurance Annuity Association. We all need a piece of diversified, well-managed professional accounts. Thank you very much.
Thank you, Dr. Ghilarducci. Commissioner Pivovar, please proceed for 5 minutes. Thank you.
Good morning. Thank you, Chairman Brown, Ranking Member Toomey, and members of the committee for inviting me to testify today. My name is Mike Pivovar, and I'm the Executive Director of the Milken Institute Center for Financial Markets. I had the pleasure of serving on this committee staff as Republican Chief Economist for Senator Shelby and Senator Crapo. I also served as a visiting academic scholar, Senior Financial Economist, Commissioner, and Acting Chairman of the Securities and Exchange Commission. I'm glad you called this hearing today on the state of retail investing. As we've heard, on the one hand, retail investors have never had it better. They enjoy more choices and face lower costs when investing their hard-earned savings than ever before. They can invest directly in securities through brokerage accounts, and competition among brokers has led to commission-free trading. Competition among exchanges, alternative trading systems, and market makers has led to the best market quality environment for publicly traded securities in history. Transactions costs are low, market depth is high, and execution speeds are fast. Retail investors can make their own investment decisions, or they can seek the advice of well-regulated investment professionals through a broker-dealer or investment advisor. Alternatively, they can achieve low-cost diversification and professional management by indirectly investing in the stock market through passively and actively managed mutual funds and exchange-traded funds. Competition among these funds has brought fees and expenses down to their lowest levels in history. The availability of retirement savings accounts, such as 401k plans and individual retirement accounts, also allows low-cost access to the stock market. And now retail investors have taken advantage of these beneficial trends over the past few decades. As Senator Toomey mentioned, the percentage of U.S. households that own stocks directly or indirectly increased from 32% in 1989 to 53% in 2019. Now, low-income households saw the biggest gains over the period, but they still lag high-income households in public stock ownership rates. Now, as we've also heard, on the other hand, the January trading frenzy in GameStop and other meme stocks and the related difficulties faced by some brokerage customers highlighted a few areas that require the SEC's and this committee's immediate attention. Now, the SEC has already said that they are reviewing actions taken by regulated entities to determine whether they have disadvantaged investors or otherwise unduly inhibited their ability to trade certain securities. The SEC has also said they are investigating whether abusive or manipulative trading activity prohibited by the federal securities laws occurred during this episode. Having worked at the Commission for the better part of my career, I have the complete confidence that the Commission and the staff will identify and pursue any evidence of noncompliance or wrongdoing. Accordingly, I focus my testimony on the market structure and infrastructure policy issues that have been raised in the aftermath of the January trading. In summary, I recommend that the SEC should, 1, evaluate whether and how to move to a shorter trade settlement cycle. 2, study how payment for order flow is working in a zero commission environment with a focus on order routing and best execution requirements. 3, evaluate various alternatives to increase regulatory reporting and public transparency in securities lending. And 4, consider amending the accredited investor definition to achieve more equitable access to investing in private companies across all income levels. Now, my written testimony provides an in-depth discussion of each of these issues, and I'm happy to answer any questions you may have. Thank you for bringing attention to these critical issues and for the opportunity to testify here today.
Thank you, Commissioner Pivovar, and welcome back again to the committee. Mr. Vollmer, you're recognized for 5 minutes. Thank you for joining us.
Well, thank you for inviting me, Chairman Brown, and for you and Ranking Member Toomey and the members of the committee. Good morning. My written statement makes 3 points, and I end with my view that what we know so far about the events surrounding the GameStop trading does not provide a sufficient basis for new legislation or regulation. So the first topic I cover is the trading in GameStop by the users of the Wall Street Bets social media forum. Based on the public information I've seen, misconduct probably did not occur in the trading of GameStop. The SEC is investigating, but my understanding is that the main group of individuals trading GameStop did not make material false or misleading statements to the securities markets and were not deceived by others. Another concern has been whether a securities manipulation occurred. The leading definition of securities manipulation, which comes from the Supreme Court, is securities trading that is artificial or not genuine. The traders using the Wall Street Bets site actually bought GameStop and the other stocks and therefore did not engage in a manipulation. Let's look at the effects of the GameStop trading on the larger secondary markets for securities. At the moment, those effects do not appear to be widespread or severe. The trading activity in GameStop, AMC, and the other securities was limited to a few companies and was short-term. Some investors made money in GameStop and some lost money. Overall, at least so far, we have not seen strong evidence of securities violations or harm to the markets for buying and selling equities on stock exchanges. There have been some question about short sales, and I hope we're able to get into that topic during the questioning. My second point in my written statement, I discussed the role of the broker-dealer Robinhood. It has come under scrutiny because of the Wall Street bets traders using it and because it has certain features that make buying and selling securities easier and more attractive, like commission-free trades or accounts with no minimum dollar amounts. The criticisms of Robinhood failed to give appropriate weight to the benefits of its business model. The Robinhood brokerage service is innovative, and it makes significant positive contributions to society and the economy. It reduces costs for consumers, makes securities trading simpler and easier. It increases consumer choice and lowers barriers to participation in the market for common stock of companies listed on stock exchanges. It therefore opens the securities markets and equity securities ownership to a much larger part of the population and to people with less income and wealth than are typically associated with participation in the equity markets. That is all to the good and serves a variety of goals that I have heard from everyone who's participating in this hearing. My final point is that the information currently available has not revealed a problem of sufficient severity to justify Congress imposing new regulations in these areas. New information could change that, but in any deliberations about possible additional legal restrictions, Congress should give weight to and respect the personal liberty interests involved. I have not heard individual civil liberty mentioned as a factor so far today, but I think individual liberty is an important tradition in our country, and Congress should not restrain personal freedom unless it has a strong reason. That's a summary of my written statement. I'd be happy to answer questions.
Thank you very much, Mr. Wilmer. Thanks to all five witnesses. I'll start with Ms. Robishodi. Why do people get discouraged even as some stocks are going up? Do people think the market is fair? What are you hearing from your clients?
You know, we hear from our clients regularly. They ask us literally the casino question, like, is it actually the best way for me to save long term? And what you and I know is that they don't have any other options if they're going to outstrip inflation. And so I do see an increasing, particularly in the younger generation, an increasing set of people that don't want to participate in financial markets specifically because they don't see them as fair or efficient.
Okay, thank you. Professor Ghilarducci, the research on stock ownership shows, as you pointed out, and those numbers were helpful, that half of U.S. households are invested in the market, many are not. I appreciated your recounting where people's wealth, how people hold their wealth, and home equity and Social Security, and that's the preponderance of wealth for most people. How does the fixation on Wall Street and stock market performance distract us from the actual economic reality for most families?
As I said, I teach behavioral economics, and psychologically, we're wired to look at most recent events, and when people get rich around us, who are much richer, we see them through the lens of the media. We feel like we are afraid, and fear actually causes anxiety. It might cause pulling back. It might cause coming back in. And it fuels bubbles. And as Robert Shiller's great new book says, it produces a narrative about economics, and a narrative is a fiction. Stock holdings, direct stock holdings, does not create wealth. And I really appreciate what Rachel said, that we wish we had a better option. I wish everybody could be in the kinds of funds that we're in, but they won't get that by directly trading stocks. I hope I answered your question.
You did. Professor Fletcher, Robinhood and other brokers' business models based on selling customers' orders to large trading firms and receiving so-called payment for order flow. if these intermediaries are willing to pay brokers and provide them services, suggests they're getting a better deal than the broker's customers, the retail customers. Explain why these conflicts are so problematic.
Thank you, Senator Brown. So payment for order flow, just as you explained, allows some brokers to say that they're offering zero commission trading to retail investors, and these commissions are then being subsidized by wholesalers. But the payment for order flow model undermines the relationship between a broker and their client, because it pits the broker's primary revenue source directly against the clients to whom they owe a duty of best execution. So under the payment for order flow model, brokers are incentivized to put their own profit-seeking interests above their clients in deciding where to route orders. And this greatly undermines the broker-investor relationship, likely leaving retail investors in a worse position.
Thank you, for Professor Fletcher. Commissioner Pivovar, I appreciate your work at the SEC in 2017 with Commissioner Stein to reduce the time it takes to complete stock transactions, reduce risk in the system. Ranking Member Toomey commented on that too. Robinhood has suggested real-time settlement as a solution to the difficulties it had in January. Is that realistic? What other changes would be necessary? Comment on that if you would, Commissioner.
Yeah. Thank you, Senator Brown, for that question. And as you pointed out, the move towards a shorter trade settlement cycle in 2017 from T+3 to T+2 was overwhelmingly bipartisan. At the time, the commission, there was two of us at the commission, Commissioner Kara Stein, who used to work for Senator Reid, who's on this committee, and myself. It was one that we viewed as a slam dunk to move to T+2. For reasons I stated in my testimony, I think the SEC should absolutely consider moving to T+1. Happy to go in these details, but you asked me about real-time settlement. I think that's a bridge too far at this particular point in time. As we shorten the trade settlement cycle, we reduce risks like market risk, liquidity risk, and systemic risk. But we also have the opportunity, or we have the challenge of increasing operational risk. In order for real-time settlement to work, everything has to work perfectly all the time. And it's important to remember that the trade settlement cycle for securities does not operate in isolation. We also have to make sure the cash gets there. And that brings into account banking payment systems. It brings into account foreign exchange settlement systems for cross-border transactions. And all of those have to be calibrated to make sure that it works perfectly. And so at this point, I think absolutely the SEC should look at shortening the trade settlement cycle, perhaps +1, but I think real-time settlement is just a bridge too far at this point.
Thank you, Commissioner. Ranking Member Toomey.
Thank you, Mr. Chairman. Dr. Pivovar, when I graduated from high school in 1980, the Dow Jones Industrial Average had a low that year of 759, and it traded at a high of about 1,000. Last time I checked this morning, the Dow was at 32,000. And I guess my question for you is, if a retail investor took whatever amount of savings he or she could and regularly invested in a broadly diversified portfolio through whichever mechanism, and did that over these last 40 years, is it likely that that investor would have earned very substantial returns on those investments? Or is it more accurate to think of the stock market as a zero-sum casino where that middle-income American is going to lose because there's a hedge fund out there somewhere that wins?
Yeah, thank you for that question, Senator. As Andy Vollmer pointed out in his testimony, the returns that retail investors get from long-term investing is exactly the same as an institutional investor who invests in the exact same securities. And what we know for long holding periods is that, on average, the stock market tends to go up. There are daily fluctuations, there are minute-by-minute fluctuations in individual securities, but what we know is that retail investors who hold diversified positions in low-cost mutual funds and other mechanisms over long periods of time will do quite well in increasing their wealth.
And those low-cost options are lower in cost and more available today than ever before. Isn't that true?
That is correct. Since the time that you graduated in 1980, not only do investors have the opportunity to invest in open-end mutual funds, but a new innovation, exchange-traded funds, has entered the landscape and has brought incredible competition to this industry, and brought fees and expenses to their lowest rates in history.
Right. A quick follow-up on the faster settlement cycle. I understood you to say that there might be some challenges, technical challenges in real-time settlement. But would you distinguish between real-time settlement and same-day settlement? And do you think that it is feasible to move to same-day settlement, or do you think we really should be happy with T+1 rather than the T+2 we have today?
Thank you for that question. I think, first of all, I think what the SEC should do, which is what we did when we evaluated moving from T+3 to figure out should we go to 2 to 1 or real-time settlement, was we took a look at the way the world existed in terms of the markets and technologies 4 years ago, and we said, let's look at it on a cost-benefit analysis. And we said, all right, well, in terms of moving from 3, do we get any benefits, and what are the costs from going to 2 to 1 or real-time settlement? At that time, 2 was the clear winner. What we heard from the industry was that the cost would be low. It would be pretty much speeding up existing back office products. And we heard from buy side, sell side, the clearinghouse, exchanges, even retail investor brokers, and securities traders. Moving to 1 had additional challenges. Not only the costs were higher, but as I mentioned in my answer to Chairman Brown, you have to get the bank regulators involved to make sure that all the bank payment systems also line up, so that you make sure that these settle correctly. Moving to 0, at that time, whenever we asked people, say, well, how do you get to real-time settlement? And the answer was always blockchain. And we said, well, can you explain how that works? And they would just repeat back louder, blockchain. And so we may get to a point where blockchain technology or digital ledger technology gets us to a point where we can achieve real-time settlement, but I don't think we're there just yet. That's just my opinion. What I think the SEC should do is put out for public comment a rule proposal proposing to move to a shorter trade settlement cycle, and put it out for public comment and evaluate the costs and benefits.
Thanks. And Mr. Chairman, if I have time for one more quick question. Mr. Palmer, recently the CEO of Robinhood testified that the restrictions that they imposed on purchasing Gamestop and a few other stocks were driven by margin requirements required by the DTCC and compliance with the SEC's capital rule. So 2 questions. One, is that a plausible explanation for the restrictions they put in place? And 2, is it really optimal to have the opacity about how those capital rules work that prevent us from knowing clearly in advance exactly what they are?
Thank you, Senator Toomey. I think the explanation that I heard from the CEO sounded reasonable. The collateral call from DTCC was sudden and in a large amount. That took Robinhood by surprise and caused them to impose trading restrictions. By the way, the trading restrictions were only one way, only on buys, not on sells. So customers could sell. They entered into discussions. They talked to DTCC. They reduced the collateral call because they had imposed these trading restrictions. The SEC is in a position to look at these areas to see if the process could be improved and smoothed, because I agree with theme in your question, and that is, I don't think either Robinhood or the customers should have been taken by surprise quite as much as they were. And if there's a way that we could smooth that out, I think that would be better for the broker dealers and better for the markets.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Toomey. Senator Menendez is recognized from New Jersey.
Thank you, Mr. Chairman. Dr. Fletcher, I want to follow up on the questions that the chairman raised with you in terms of order flow issues. Doesn't it create a conflict of interest, or at least an appearance of a conflict, when a broker receives a payment from a third party, in this case a market maker, to fulfill their customers' orders?
Thank you for that question, Senator. Yes, it absolutely creates that conflict of interest because brokers are now, with this payment for order flow model, brokers are incentivized to put their own profit-seeking interests above the interests of customers when deciding where or how to route these orders. This also should raise concerns for us in terms of customers being able to get the best execution from their retail brokers, from their brokers. And so, yes, I agree with your question that this does raise these questions for us.
And so how does an investor know that their broker is working to find the best execution quality for their investor, not simply working with the market maker that pays them the most?
So currently under SEC rules, there are disclosure obligations on retail brokers to state what their price improvement is from having routed their orders through different to different wholesalers or market makers. But the retail investor really has very little information in terms of knowing the price at which their order is executed or what exactly that price improvement was. So retail investors do have less information, and so we do need more or better disclosure for retail investors to be able to evaluate this information.
Are there other costs that payment for order flow imposes on investors?
One of the things that we want to probably be thinking about with regards to payment for order flow is whether or not retail investors are truly receiving a best execution when they are trading, meaning if there are quotes that are, so for example, there are quotes that are available that are odd lot quotes that are typically not included when we think about what the best price is available for an order. And right now, one of the things that I would recommend is that the SEC think about amending some of their rules to include these odd lot quotes such that truly the best price available is included when we think about the execution for retail investor orders.
Thank you. I'd like to turn our attention to racial inequity in the stock market. Historically, stock ownership has been dominated by white Americans. According to the Federal Reserve, in 2019, only 34% of Black families, 24% of Hispanic families owned any equities, compared to nearly 61% of white families. This disparity only grows larger when you look at the value of equities held. Among families with equities, a typical white family has over 50,000 in holdings, compared to just over 14,000 for a typical Black or Hispanic family. These equities represent funds that families can tap into an emergency, such as the pandemic. We have ample data showing that the pandemic is having a disproportionate effect on minority families, and the lack of savings is one reason why. Dr. Ghilarducci, what are the consequences of disproportionately low participation in the stock market by Black and Hispanic families? And what are some of the challenges holding back minority families from owning equities?
Thank you so much for that question. A lot of my research at Notre Dame has been on non-white families with anthropologists exactly exploring that question. What holds non-white families, Blacks and Hispanics, from having wealth is not having access to retirement plan at work. Wherever these families have significant holdings, meaningful holdings in stocks and bonds and private equity, in the kind of wealth that we have, because we're workers who have a retirement plan at work, they don't have because of their workplaces. So if we worked to expand retirement coverage to all workers through innovative pensions for all plan, they would have wealth.
One last question, Dr. Ghilarducci. Is the lack of stock ownership among minority families, I should say, an impending factor in their ability to build wealth?
Absolutely. They need Social Security, they need home equity, and they need access to financial instruments, but through professionally managed funds, not through trading on their phone.
Okay. Thank you very much.
Senator Shelby from Alabama is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to take a second here and welcome again Dr. Pivovar back to the committee where he spent a number of years, and before he a member of the Security and Exchange Commission itself. Thank you for being here with us today. I have a question for you, following up on what the area that Senator Toomey was involved in. I've always asked about cost-benefit analysis, how important that is when you're dealing with a new regulation or proposed regulation. What has the SEC adopted a number of years ago, and what do they do today when they're looking at a regulation, Dr. Pivar?
Thank you, Senator Shelby, for that question, and thank you for your warm welcome back to the committee. It's great to see you and the other members of the committee again. I think you're referring to the current guidance in economic analysis that the commission adopted in 2012. So then SEC Chairman Mary Shapiro decided to enhance the role of economic analysis at the commission. It was due in response to a couple things. One, the commission had lost some well-publicized cases in the courts for not doing good, proper cost-benefit analysis in accordance with the Administrative Procedure Act and some of their other statutory requirements. And two, part of it was your leadership in terms of making sure that as the regulators implemented the various Dodd-Frank provisions, that they were doing cost-benefit analysis to evaluate how they were going to move forward. What the guidance did was essentially give the chief economist at the commission more authority over the rulemaking process, got the economists involved earlier in the rulemaking process to help standardize how they think through the rules. And so what it does is it forces the commission to go through a very important exercise of saying, all right, what is the justification of this, of why you're thinking about going forward? It could be a mandate from Congress, or it could be a discretionary choice based on the fact that markets change. It forces them to adopt a baseline for the status quo, and then to look at various alternatives and evaluate each of those alternatives in terms of the costs and benefits. And that will then point them in the direction in terms of which is the most appropriate way for the commission to move forward. That guidance has been followed by every chairman, both Republican and Democrat, and I was heartened to see in response to your question at the nomination hearing last week that Gary Gensler, if confirmed, would also continue to follow that guidance.
Would you give us just a thumbnail sketch of if there's a proposal to come forth with a regulation, a mandate by the SEC dealing with the current problem, order placement and so forth. What would be the steps to do this? How would you go about that if you did it?
Yeah, thank you for that question. I mean, that's one of the great things about the regulatory process that we have is it provides for valuable input from the public. So first of all, the SEC would decide whether they want to put a rule proposal out, or maybe they're not there yet. Maybe they're still contemplating whether to put out a formal rule proposal so they could do a request for comment. And then what the SEC does is it puts out and provides to the public their own economic analysis in terms of what they think the costs and benefits are. And then they ask explicit questions of the public and ask them questions like, did we get this right? Do you have any other numbers that would support or contradict our finding? Or do you have any other numbers that would help us make this decision? It's a very public process. They go through open meetings. The public can participate. It's on their website. Anybody can submit comments to this process. And then the procedures and the statutes that the SEC has to follow, they have to take into account those public comments. And then they go back and reformulate their economic analysis with this new information, and they can choose to either move forward, not move forward, or move in a different direction. So it's a very robust process.
One question to Mr. Vollmer. Mr. Vollmer, in your opinion, did Robinhood perform in a rational, thoughtful way in dealing with their situation when everything was a little frenzy?
Senator, they certainly reacted in a rational way, and they were as thoughtful as time permitted them, but they were under a great deal of time pressure with the sudden collateral call. And so they reacted quite well, and they did impose the trading restrictions, which they did not want to do, but they tried to relieve those when they could. But they collected collateral that they could put up to DTCC very rapidly.
Mr. Chairman, thank you very much.
Senator Chester from Montana is recognized.
Well, thank you, Chairman Brown, and I want to thank you and Ranking Member Toomey for holding this hearing, and I want to thank everybody who's testified. I appreciate all of your time, and thanks for being here. We have known for a long time that there are perverse incentives in our systems, and that those systems influence where companies make investments, and sometimes more importantly, where they make cuts. Many of us here agree that there would be benefits to a system where companies focus on the long term and helping their communities and their workers, not just on short-term profits. Now, I want to be clear, I don't feel bad for those who have lost money trying to game the market. But I am worried about those regular folks who saw this and tried to get in on something like this and then get hurt. The recent market volatility presents an opportunity to take a really hard look at our securities regulations and the systems that we have in place. Investing in companies in the stock market should not be something that can only be gained by the wealthy. I think we all agree to that. So it's my view, our system should work for everybody that is trying to invest in their future. So it seems to me that something isn't working here for companies and communities, and especially the retail investors. So this question is for all of you, and I'll ask you to try to make it short. Some of you have already addressed part of this, but if you were able to make any changes and were in charge of all of the decisions, whether that's in Congress or at the SEC, in SROs, everywhere, what would you do to improve how our system works for retail investors? And you can just go in order that you presented your testimony.
Thank you so much, Senator, for that question. So the thing that I would want to make our system work better for retail investors is better information for our investors as to what the true costs are for their trades and for the transactions that they're engaging in. Too many investors see this zero commission model and think that it truly is zero commission. And I think that there is information that they would need to truly evaluate the costs and the risks of these transactions.
Thank you.
Thank you for your question, Senator. If I could do one thing, it would be to impose a financial transaction tax. I believe that that's a very negligible cost to the everyday investor, and it's something that would stop the high frequency traders from dumping gasoline onto the already roiling fires of mistakes or other market disruptions that come about.
Okay, so just to be clear, the tax would be put on for the purpose of stopping the high volume folks. Correct?
Yes, I believe the purpose of the tax is to add an additional cost, and that additional cost would be an invitation for deliberation, which I believe is something that investment decisions always benefit from.
Thank you. Next.
Three things. That the economic analysis should include behavioral economic analysis at the SEC. They should look at the way that the phone app looks like, and to cut out the obvious addictive aspects of the games. The economists should be smart about that. Second, I agree with Dr. Fletcher that there should be a revelation, just like we do in professional investing, what the true costs are. And third, Nobel Prize economists back up what Robinashi just said, that sand in the works, slowing down the trading with a securities tax would help make the market work better.
Yeah. Next.
Thank you, Senator Chester, for that question. So a few things. One, we already talked about, I think shortening the trade settlement cycle would help everyone, allow retail investors to get access to their funds quicker, but also take risk out of the system. Second, amending the accredited investor definition to achieve more equitable access to private companies across all income levels. And third, just the general one, better disclosures for investors. As you know, the SEC is a disclosure regulator. And so one of the most important things that the SEC can do is arm investors with information to make informed choices. And so one example of that, Professor Fletcher had mentioned better information about order routing and best execution. I wholeheartly agree. In my written testimony, I attempted to look to see whether Robinhood customers in particular, how their order executions were done. And unfortunately, with the publicly available information, I couldn't do that directly. So I think better, more granular information about how and why brokers are routing their trades and the outcomes from that would go a long way to protecting investors.
Mr. Volmer.
Thank you, Senator. I'll be quick. Two things. First, reduce the cost and complexity of public offerings. Second, so I'm in broad agreement with Mike Pivovar. In private transactions, the difference between accredited investors and non-accredited investors should be eliminated. And instead, in certain private offerings, there should be required short form core disclosures.
Okay, thank you all. Thank you, Mr. Chairman.
Thank you, Senator Tester. The senator from North Carolina, Senator Tillis, is recognized.
Thank you, Mr. Chairman, and thank you all for being here. I've been in and out of this committee. I've got 2 other committee meetings going on at the same time, so I'm sorry I haven't been here for all of your testimony. I was here at the after Senator Shelby's and Senator Tester's questions, so I want to get right to the financial transaction tax. I know that that's been something that's been offered up in the wake of the Robinhood Gamestop saga, but there seems to be, I'm trying to understand how we can avoid what appears to have been the consequence for financial transaction taxes that have occurred in other jurisdictions, and then some countries have thought about it and backed off of it based on these experiences. Reputable studies indicate that the FTT would actually reduce the value of a typical investor's 401k, and maybe as much by 8.5% in a lifetime of savings. That looks like people may have to work an extra 2.5 years to make that up to realize the same amount of savings. So do you disagree, Professor Girarducci, that it would have that effect on, say, or on potential savings?
Thanks a lot for bringing up that research, Senator Tillis. It's really pertinent. That data is a bit out of date, and it also is distorted. If 401k traders or pension funds traded all the time, the tax would reduce their savings. Also, that study was done on a tax that was much higher than the kinds of taxes that are produced now. It is well known in the economic research that if you get the tax low enough that you don't hurt long-term investors, but that you slow down the high frequency trading. So it has to be done right, but it is backed, the good effect is backed by many studies, not that one study you're citing.
Thank you. Do you know, I know the CBO projects the FTT would result in a almost 44 billion first year net loss of tax revenues, and would immediately lower the value of financial assets. Are you just saying that that these studies have set the mark too high? And so in your opinion, what is the sweet spot that you think would actually affect the high volume investors, but not affect the individual investors that are now the substantial number are in the market?
I just read a dissertation that had that number, that sweet spot. It's a really excellent question, meaning I'll have to get back to you with what that number is, but there is a number. And the CBO study looks at the short-term effects. People won't be trading and realizing those capital gains, but we actually don't want them to. We want them to hold those gains longer. So I'll get back to you with that number.
Thank you. Mr. Pivovar, thank you for being here, and I'm sorry our time's limited. I won't be able to ask questions of all of the witnesses, but am I correct that the act of front running that some worry market makers could engage in is already illegal?
That is correct.
So should the discussion be more around enforcement of what we already have on the books, or do you think we need to go further than that?
No, I think you're absolutely right. I think it's enforcement of what we already have on the books, right? And so if I may just go into a little more detail on that, right? There is an inherent conflict of interest when in the presence of payment for order flow, and the SEC explicitly recognizes that, and that's why we have best execution requirements, and that's why the SEC actively enforces those best execution requirements. And if I may, if the SEC were to ban payment for order flow, we would likely go back to commission trading. It would cost to trade. And what that does is it doesn't eliminate a conflict of interest, it just changes it. So when I was in the private sector, I worked for an economic consulting firm, and we provided expert witness testimony on behalf of plaintiffs in the FINRA arbitration context, where brokers were churning the accounts of their customers. And so simply, getting rid of payment for order flow just moves the conflict of interest. And again, it has to be done through enforcement.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Till. Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. And I want to pick up where my friend Senator Tillis left off. And I want to start with Professor Fletcher, but I would like to hear from Michael on this as well. On this question around payment for order flow, I think, we've now seen evidence that about $6 billion of payments to brokers and others within the payment for order flow. I remember, gosh, it's probably been 7 or 8 years ago, the Royal Bank of Canada had a chart that kind of blew me away about the bespoke nature of all this order flow payment. I think it is extraordinarily not transparent. I think $6 billion generates an awful lot of profits. I think particularly when you've got only a few major firms that are on both sides of the trade around payment for order flow. And I'm going to want Michael to comment on this, but it really seems out of whack to me. And the argument that says payment for order flow is to increase liquidity, it just doesn't seem to be the case. I mean, if you look at the fact that of the 9,000 securities that are traded, the top 10%, less than 1,000 of them, account for about 77% of all that liquidity. It would say to me that, you don't need that payment for order flow to increase liquidity because you've already got liquidity. And what I guess I would start with you, Professor Fletcher, I think you've raised these issues as well. We see large enterprises with Fidelities and Vanguards that don't make payment for order flow. Has that decreased liquidity? Why wouldn't we, if we need liquidity payment, why wouldn't we pay for, say, the bottom payment for order flow for the bottom 90%, but not the top 10%? And have we seen in countries like the UK and Australia, which have banned payment for order flow, any significant decrease in liquidity? Why don't we start with you, Professor Fletcher, and then I've worked with Michael in the past, want to hear. I know he's got a different view, but Professor Fletcher, would you start?
So thank you so much for that question, Senator. So in terms of the impact of payment for order flow on liquidity, I do not think that payment for order flow is needed for us to achieve liquidity. We have a deep financial market that we've had before payment for order flow. And just as you noted, there are jurisdictions such as the United Kingdom and Australia which have banned payment for order flow. And research that I read from the United Kingdom recently has not indicated that there has been any meaningful decline in their liquidity. Indeed, what that research has demonstrated is that there has been better execution for retail investors at the best price in the absence of payment for order flow. So that would indicate that there is less conflict and investors are able to get better price execution in the absence of payment for order flow.
And we've not seen, by the way, if you are a Fidelity or Vanguard customer where they're not paying for payment for order flow, are they getting less good execution terms than other retail investors?
So the problem with that, Senator, is that we don't have enough information to even know that, right? And so this is something that I believe that we have some consensus about in this hearing, is that we don't have enough information to know whether or not retail investors with Fidelity that doesn't do payment for order flow have a better or worse execution than retail investors with other brokers that do have payment for order flow. And so that is a point at which we do need more and better information.
And I would say that I fear, I've talked to our friends at Robinhood and I've spent some time looking at this. I really do fear, and I'm all for democratization of our market system, but increasingly I fear that oftentimes these retail investors are frankly not customers. I think they are the product, and many of us being the product for Facebook, and I think we are oftentimes that product is manipulated. And Michael, I want to give you a chance to respond on this. It just seems to me that I know the excuse is always, well, this is the way you get to no cost, lack of brokerage fees, but obviously some of the large enterprises are able to do this without that payment for order flow. And I think there's inherent conflict. In that last 10 seconds, you want to give a bit of a rebuttal to my point?
Yeah. Thank you, Senator, for giving me 10 seconds to respond to that. So I would start with agreeing with Professor Fletcher, is that this is an empirical question, right? The concerns that you have raised, right, on the payment for order flow side are the same concerns that people have raised on the churning side when in the presence of commission-based trading. And it's ultimately an empirical question. And unfortunately, right now, we just don't have the data for that. And so that's why I think it's important for the SEC to consider getting better data, getting better transparency in this, so we can actually evaluate what the proper policy alternatives or policy choices are.
And I know my time's up, but Mr. Chairman, I hope we would look at some of these questions around best execution, because I think I actually, frankly, have seen some evidence that there's some manipulation going on there, and I think it would be a subject that would be well worth this committee looking into. Thank you, Mr. Chairman.
Thank you, Senator Warner. Senator Hagerty from Tennessee is recognized for 5 minutes.
Chairman Brown, Ranking Member Toomey, thank you for holding this hearing today. As noted, this hearing is an important part of Congress's oversight of our capital markets, and it's also a great opportunity to reaffirm support for retail investors' participation in United States capital markets and for maintaining our markets' fairness, our order efficiency, and global competitiveness. Before turning to the specific market events that led to this hearing and the potential areas for improvement, we mustn't lose sight of the fact that our financial markets are the envy of the world, and for very good reason. They're the most robust, the most efficient, and they deliver the greatest liquidity and funding at the lowest cost of capital. They finance our great economic opportunities by connecting retail and institutional investors with American individuals and families that are looking to achieve the American dream, including higher education, home ownership, and financial security in their retirement. And with our great businesses that need capital to thrive. Our vibrant capital markets play a vital role catalyzing the economic growth of communities across America. We mustn't forget that, particularly as our economy is recovering from a pandemic-induced recession. Now is certainly not the time to impose unnecessary constraints on our capital markets and market participants that would only slow America's recovery from the pandemic. Mr. Pivovar, I want to thank you for your testimony. Today may be the golden age of investing for retail investors. I say may, only because with the pace of our financial technology innovation, who knows what tomorrow will bring. Major brokerages now offer zero commission trading, but they must continue to follow all legal obligations to serve their customers. Reams of financial and trading data can be immediately accessed at the touch of an app. And while stocks may not always go up, our major indices have repeatedly hit record highs over the past 4 years, in large part due to solid pro-growth policies. So, Mr. Pivovar, having said that, many investors were caught off guard when Robinhood temporarily halted trading in certain shares. As a result, a lot more people now know about short selling, margin trading, clearinghouse deposit requirements, and settlement times. Do you agree that the SEC, again, working together with the private sector, can accomplish more by focusing on investor education rather than engaging in just simply more government paternalism?
Thank you, Senator Hagerty, for that question. I think in terms of the SEC's authority, I think the SEC already has all of the regular authority it needs to address a number of the issues that I identify in my testimony. In terms of investor education, yes, it's extremely important. As I mentioned, the SEC is a disclosure agency. And one of the things is, as being one of the non-lawyer commissioners at the SEC that I worried about was that, a lot of the disclosures were written by securities lawyers and only understandable by securities lawyers. So that's why I spent a lot of time with our Office of Investor Education and Advocacy to make sure that we're getting the word out to investors. I also spent a lot of time working with our team that was given the authority or clarified the authority in Dodd-Frank that the SEC could engage in investor testing and actually go out and do focus groups and surveys to make sure that the information that the SEC was giving to investors was understandable and digestible. And then finally, I just add that when I was acting chairman, one of the only major personnel changes I made was to add a position specifically focused on military outreach One of the things that had happened during that time was that the military was moving from the old pension system to a defined contribution program, the TSP program that Professor Ghilarducci mentioned, and had the opportunity to meet with some of the sailors on the USS Carl Vinson. And some of these young sailors were fantastic at, launching and catching planes landing on the aircraft carrier, but they didn't know the first thing about investing for their future. And so we embarked on a specific initiative to make that information available to them and talk to them about the power of diversified, low-cost savings for the long term, the matching services and saving for their retirement. I'm happy to say that that's been a very successful initiative.
And in the minute we have left, are there any specific actions that you would suggest for our retail investors today as you look at the evolving markets that we're in and the challenges ahead of us? Any specific guidelines that you would propose or suggest for our retail investors?
Yeah, it would be the same advice that I gave when I was a professor of finance, which is do your homework. There's an incredible amount of information that is out there for investors that we've never had before, whether it's on the internet or whether it's through educational institutions and the like. And if I may talk a little bit about gamification, right? I'm not a Robinhood customer. I've never seen the app. I don't know what types of gamification is involved there, but I do know that using games and simulations is a very effective way of educating students. I note that many business schools are moving away from the traditional case method and lecture method to move towards simulations and trading. And even if you think in cybersecurity defense, training the next generation of folks working in cybersecurity, it's all through games. So in terms of gamification, I'd caution in throwing the baby with the bathwater, and that gamification could be used for effective education.
Got it. Thank you very much.
Senator Warren was having technical issues. Is she able to join us? We will come back to her. Senator Van Hollen of Maryland is next.
Thank you, Mr. Chairman, Ranking Member Toomey, and to all our panelists, thank you for your testimony today. We know that Wall Street has made an art of high-frequency trading and rank speculation that's fattened the wallets of a few while putting everyday investors at greater risk. And the market events of last January brought attention to Robinhood's practice of selling user data to hedge funds that do high-frequency trading. As has been mentioned today, one way to deal with that and cut down on high-frequency trading and its risks to market stability would be to place a small fee, say 0.1% on these Wall Street transactions. It would generate billions of dollars that we could invest in greater opportunity for other Americans. It would reduce wealth and economic inequality and reduce volatility in the market. That's why Senator Brian Schatz and I plan to shortly reintroduce our bill to impose a financial transaction fee, a high roller fee. And let me start with Ms. Robert-Shody. I know you mentioned this. Could you just elaborate a little bit more on, first of all, the risks of high frequency trading? And then second, how a financial transaction fee of the kind I'm talking about could reduce that and be a benefit.
Certainly. Thank you so much for the question, Senator. I'm happy to hear that you'll be reintroducing that legislation. In terms of the risks, I mostly see them as systemic. When we have that classic recipe for market disruptions, what we've seen time and time again, whether it's the Great Recession or the flash crash, is that high frequency trading simply exacerbates that. In terms of how the financial transaction tax actually shows up for regular Americans, if you'll allow me, I'd like to use myself as an example. I was born into rural poverty in a segregated town. I grew up in an all-Black family. We were very poor. I've been homeless multiple times as a child. Thankfully, I graduated at 15, went to college. Any of the extra money that I've made in my entire working career has gone either to my extended family or back into my business. But at the age of 42, I have managed to save $100,000 in my retirement account. I was looking at my average trades. My average trade size is about $9,000 on my own account. If the financial transaction tax that you're talking about of 10 basis points or 10% of 1% were to come about, that would cost me about $9 per trade. And I have about 20 trades per year. And this is very similar to the situation that is true for most of my clients. $9 is less than the $9.95 that the discount brokers were charging when they were actually charging trading, when they were charging the commissions for trades. And so to me, that seems very reasonable as a small amount of insurance, a price that I pay as a participant in an orderly, fair, and efficient market. And one of the ways that I know that that's happening is because it's significantly slowing down the non-human algorithmic high frequency trading that's caused so much damage.
Well, I appreciate that. As you say, it really would create a disincentive, a financial disincentive for that high risk conduct that puts other people in the market at risk. Professor Ghilarducci, you also mentioned this. Could you just elaborate a little more? Because this is going to be a big debate, I think, as we consider different options for revenue. This will be an attractive one because in addition to raising revenue, it has these other benefits. Could you just talk a little bit more about that?
Right. I think the economic research has been done. It's an idea whose time has come, especially if you reintroduce your bill. The costs and benefits have been evaluated since James Tobin at Yale in the 1970s proposed it. And economist after economist have rerun the numbers. And if it's too high, it will have bad effects on long-term savings. If it's too low, it won't have any effect. If you get it just right, and actually 0.1% is about right, thank you for reminding me that what it does is it shifts from high frequency trading, it changes behavior towards more long-term holdings, exactly where all of us want people to be with their stocks. So I think you're on very solid ground in terms of the academic research, that the costs are too high of a tax and the benefits of just the right one encourages wealth accumulation.
Well, thank you. I look forward to following up with you and others on the panel as we shape this and have the debate. Thank you all very much. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Kramer of North Dakota is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses. And like Senator Tillis and several of us apologize for coming in and out of the hearing while we cover other hearings, but grateful. So bear with me if you've answered this several times. Dr. Ghilarducci, I want to get it real basic with you if I can. In your testimony, you state the following, I'm going to quote or read your quote: "We need innovations in public policy to give more Americans access to what we know works, professionally managed retirement coverage that allows everyone to benefit from the stock markets the same way you and I do in TSP and a defined benefit plan, TIAA, and so on." So just so I'm really clear, do you believe that all Americans should be required to pay for investment advice?
Investment advice. I think all Americans should be in a retirement account. Oh, I see. And so if you're in a retirement account,
have to pay for it.
You're paying for investment advice. You know what? Americans should have access to investment advice that's worth it. A lot of investment advice they get is from conflicted investors, and that's not good. But if we're going to hold our pension fund money in stocks, the advice about where to put it should be high value.
And high value being high price, I assume.
No,
So-
well, just that the cost, and the benefits from the cost, are outweigh it.
Sure. All right. In some sense, this whole hearing is obviously fundamentally about the level of access that retail investors should have to own shares of companies, right?
Yeah.
And some of you are positioning that the system's rigged. It's a casino. You heard all the terms. Investors should have to rely upon professional advice for a fee to have access. Let me ask you, Mr. Vollmer, Mr. Duart, do you believe retail investors in the marketplace benefits from direct retail investor access to the market, and if so, why?
Shall I go first, Mike?
Go ahead.
I think that retail investors benefit hugely from direct access to direct ownership of the equities of operating companies, but they should do it with their eyes open, as Mike Piffelvar said, and accept responsibility for the consequences. It's not a casino. The securities markets are not a casino. They have risk. There's significant risk to them. But as people have pointed out, stock markets in the medium and long term produce positive returns. Casinos, if you are in the medium or long term, you will lose money. So yes, they ought to have direct access, but they ought to be smart about it and recognize their limitations. And clearly, investing in mutual funds or index funds is by far the better approach for nearly all retail investors.
Including me, by the way. Mr. Pivar, would you have anything to add to that?
Sure, I agree with everything that that Mr. Vollmer had talked about. What I would add to that is it's important for investors to have the choice to do both, right? They have access to indirect investments through low-cost, professionally managed funds, and then investors have the opportunity to invest some of their money on their own, do their own homework, do their own due diligence on the firms, and over time what that does is, whether it's through wins or losses in the stock market, they learn. It gets them more engaged in the stock market. As I mentioned, in business schools, we do, back when I was teaching, we even started doing some simulations in terms of paper money portfolios, and it's amazing how much students get involved in terms of the stock market and learning about companies when there's pretend money or real money on the line. So I think it really provides the opportunity for people to learn over time about the financial system.
I appreciate that. I appreciate all of you, really. Every time I participate in one of these, I keep thinking, speaking of schools, several of you are professors, or at least have been, or get to be on an adjunct basis every now and then. I just think every business school ought to take some Senate hearings like this and just play them for students, because I think there's a lot to be learned. So I'm grateful to all of you. Thank you, Mr. Chairman. I'll yield back the rest of my time.
Thanks, Senator Kramer. Senator Warren from Massachusetts is recognized for 5 minutes.
Thank you, Mr. Chairman. So in recent weeks, I've sent letters asking questions from those at the center of the GameStop market chaos. And I've received responses from the SEC, FINRA, Robinhood, and Citadel, the giant hedge fund. I ask that those responses, or lack of responses, Mr. Chairman, be entered into the record without objection. Mr. Chairman?
I'm trying to unmute. I didn't see that coming, Senator Warren. Without objection. No. So ordered.
All right. Neither side advertised it publicly, but Citadel Securities was Robinhood's go-to partner for handling retail trades. At the height of the GameStop trading mania, Citadel alone was handling more volume than all of NASDAQ. And while Citadel was raking in cash from executing GameStop trades with one hand, its hedge fund affiliate was bailing out another fund on bad GameStop bets with the other hand. So I asked questions about Citadel and its relationship with Robinhood, because this gets at the heart of what's wrong with Wall Street. It's riddled with conflicts of interest that allow the giants to win every single time. Here's some of the information that Citadel would not provide. How much money Citadel made from GameStop trades? What information on trades Citadel receives from Robinhood about GameStop and about millions of other trades? And then how Citadel uses that information it gets, whether it passes it along to its affiliates to make even more money. Professor Fletcher, is this information important for understanding the role that Citadel played during the recent GameStop volatility? If, say, Citadel had executed the overwhelming majority of GameStop trades during the turmoil, or had been receiving an information advantage from executing Robinhood orders, could that potentially hurt retail investors?
Thank you, Senator Warren, for the question. Yes, so to just go right to your question, yes, this information about Robinhood and other retail brokers, customers trading is definitely essential to our understanding of these recent market events. One of the things that we know is that Citadel does receive a lot of information about customers' orders from Robinhood, but it would also be important to know whether and how that information is being used by Citadel and others in order to have a clearer understanding of the recent volatility and any role that they may play in the swings, in the price swings that the stock price experienced.
So thank you. Robinhood gets more than half of its revenue from collecting fees for pushing its customers' orders to outfits like Citadel. And Citadel makes its money off the spread. They pocket the small difference between the buy and sell price of a trade. And this is important, Robinhood also receives a percentage of the spread on each trade. So Professor Fletcher, both the number of transactions goes up and the spread tends to widen during periods of market turmoil. So am I understanding correctly that when share prices for GameStop or any other company undergo extreme swings, Citadel and Robinhood both stand to make more money while investors pay more to trade?
Yes, Senator Warren. This is generally what happens in times of stress. And so it's also important to keep in mind that market makers like Citadel are both in the exchange trading markets and executing huge volumes of orders off the exchanges. So while pension funds and other institutional investors generally can't interact with retail customers, and retail customers are siphoned off and prevented from interacting with institutional investors, Citadel sits in the middle and is able to interact with all of them. And this benefits Citadel by being able to segment the markets in this way, which dilutes the number and quality of orders that we see on the exchanges. And the profitability is there for Citadel for doing so.
Right. And this is why the SEC needs to investigate the GameStop run-up. The stock market is supposed to be about capital formation, creating long-term value for companies so they can grow and create jobs. This is good for the American economy and for American families. But when big sharks like Citadel and Robinhood come out ahead, no matter what happens, and when the information they gather isn't disclosed, and when it's secret how that information is used, it's easier for these giants to skim off the top at the expense of small investors and working families. The SEC's job is to provide transparency about these companies' market tactics and make sure they don't rip off customers. They could start by following up on my questions to Citadel and Robinhood. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Cortez Masto from Nevada is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, everyone, for being here. It's a great conversation. First of all, let me just say, I recognize that the SEC is undergoing an investigation as well, and I look forward to the results of that investigation. And then as a senator from the great state of Nevada, born and raised in Las Vegas, I am listening to all of the comparisons with the casinos, particularly across this country. But knowing one thing, our casinos do not allow anybody that's under the age of 21 to gamble. And there's a reason. We want to protect our youth. So let me ask you this, because I am concerned about the gamification of the market and what we're seeing with some of these apps. That's clearly looking to target a particular area of our, I think, of our youth who are now more engaged in gaming apps than we've ever seen before. So let me ask Professor Fletcher, should the design features of trading apps be regulated?
At a minimum, so thank you very much for that question, Senator. I think at a minimum, they have to be studied, right? Because one of the things that, as Professor Ghilarducci has noted, is that there are certain behavioral economics at play here. And so when we have things like confetti raining from the sky for having done a trade, this raises concerns about the types of encouragement that we're giving traders for just doing trades, which may be problematic as we think about trying to have encourage appropriate behavior within the capital markets.
Thank you. So let me also ask this then, particularly for young adults, do retail broker dealers provide enough education and disclosure to individual consumers or there should be more?
Currently, it does not seem, I would be able to say that it does not seem as though that these broker dealers provide that type of education to retail investors. I know that this is a focus of Professor Ghilarducci's research. And so currently, I do not believe that they provide this level of education for retail investors, which then allows them to profit, right, off retail investors engaging in risky behavior that is not wealth maximizing for these investors.
So let me ask then, Ms. Roboshadi, do you think that anybody under the age of 21 should be allowed to engage in the stock market, particularly what we've seen with Robinhood, a young man who was only 20 years of age committed suicide because he felt he overextended himself?
Thank you very much for the question. And it was very sad what happened with that particular young man. I do believe that given that we've all transferred responsibility for our retirement from these defined benefit plans and pensions down to us all being responsible for ourselves, we need to get as early a start as possible. So yes, I would recommend that people under 21 be able to invest, yet it's incumbent upon us as a society in that transfer of responsibility for our long-term financial security. We need to also transfer the education. Right now, it's just happening within families, mostly from father to son and wealthy families. And I believe that's a big underpinning reason for why there's such concentration of wealth where it is in the country.
If I may, I don't think it should be banned without proper study. As I mentioned in my testimony, if you ban payment for order flow, you're highly likely to go back to commission-based trading, and it just shifts the conflict of interest from best execution requirements to churning accounts, and then that's the best interest requirement in terms of customers. So we have to be careful in these things. It's best left for the SEC to study the issue. I agree with Professor Fletcher on that. The SEC absolutely should study it in a zero commission environment. Look at all the costs and benefits, and then make a decision based on that.
Okay, thank you. And Mr. Volmer, you raised your hand, so you believe the same thing. Is that correct?
I'm sorry to interrupt. I start with Mr. Pivovar and Professor Fletcher. We need to look carefully. We need to proceed cautiously here. Start from the proposition that every participant that provides services in the market deserves some reasonable, fair compensation. The broker-dealers, the wholesale market, the wholesale broker-dealers who also act as internalizers like Citadel Securities, and the exchanges. They all provide important services to our capital markets. They all deserve compensation. Payment for order flow is a method of compensation. If you remove it, you need to find another mechanism. That's why Mr. Pivovar says you're going to reinstitute commissions on trades. So everything is interrelated here. All these relationships are connected. So I think we need to proceed cautiously, and that's, I strongly agree with, let's look, gather evidence and data, but I don't like the payment for order flow because it's disruptive and it's not obvious to investors.
Thank you. Thank you all.
Thank you, Senator Cortez Masto. Senator Ossoff from Georgia is recognized. His camera's not on, and he can proceed with or without it. Senator Ossoff. There you are.
Thank you, Mr. Chairman. Appreciate that. On Saturday, with overwhelming bipartisan support, the Senate passed the American Rescue Plan. And unlike traditional monetary expansion, which subsidizes investment banks, and unlike other recent fiscal measures that have subsidized corporations and wealthy donors, 0% of the stimulus checks and tax credits in this bill goes to the top 1%. And I'd like to point out for colleagues on this panel who oppose the bill that following Senate passage, the OECD has revised its growth forecast for the US economy, doubling it from 3.2% to over 6% this year. And the OECD projects that this legislation will boost global growth by a full percentage point this year. Ms. Robichotti, the title of this hearing is Who Wins on Wall Street? We just passed an ambitious fiscal measure in the Senate. Given that the bottom 50% of American households by wealth possess just 1% of total national wealth held in the stock market, what, in your view, are the benefits of economic policy that gets cash directly to low wealth households by fiscal measures versus economic policy that adds liquidity to financial markets via the banking sector, like traditional monetary policy?
Thank you very much for the question, Senator Ossoff. The way that it actually occurs when you give money to people who come from the kind of background that I have, they're more likely to spend it. We learned about this, in economics textbooks as the marginal propensity to consume. But it's just true that if you give money to those who are more in need, they're going to be more likely to spend it and circulate it throughout the economy. And so it doesn't just help them. It's not just something that we want to do to help the vulnerable. It's actually something that creates a multiplier effect throughout the entire economy. So I believe it just makes good economic sense.
Thank you. And what, in your view, are the costs, Ms. Robiscioti, of economic stimulus, like traditional monetary expansion, which adds liquidity to financial markets by allowing investment banks to access credit at extraordinarily low rates, or just transfers cash to financial institutions' balance sheets via processes like quantitative easing?
Again, thank you for the question. Those who are doing well at this point with their outsized gains, particularly during the pandemic, don't need any more help. What it actually does is just sequesters that money in the hands of those who are most wealthy and aren't going to put it back necessarily into the economy. You know, we had that argument of trickle-down economics, and we can kind of see from where we all are that that's not actually what happened. And so it actually harms all of us to make sure that those types of economic stimulus are going to the wealthiest in the country rather than going where it's going to actually do us all some good.
Thank you, Ms. Robiscioti. And Professor Fletcher, you opened your testimony by rightly noting, quote, "A core purpose of the financial markets is to facilitate the efficient allocation of capital." I'm curious for your perspective on this. Over the last 15 years, U.S. investment banks have required multi-trillion-dollar bailouts to avoid insolvency. And even after the acute credit crisis in 2007-2008, central banks and the Federal Reserve have continued to grant investment banks access to credit at record low rates and engaged in sustained quantitative easing, adding trillions of dollars to financial markets. Do you believe, Professor Fletcher, that the U.S. financial system in its current configuration facilitates the efficient allocation of capital?
Thank you so much for that question, Senator. I think that the U.S. capital markets are among some of the best capital markets in the world, but there are significant issues with the market structure that we have currently, in that we have retail investors that are able to make risky decisions without fully appreciating the costs of those decisions. Within our capital structure, we also have questionable valuations for some companies that may not be fully reflective of an efficient market. So if I believe that our markets are fully efficient, no, not quite. But do I believe that they are among the most efficient in the world? Absolutely.
Thank you, Professor. Thank you, Mr. Chairman. I yield back.
Thank you, Senator Ossoff. Thank you to the witnesses for being here today, for your really incisive testimony. Thank you for that. I just make a brief announcement for senators who wish to submit questions. For the record, these questions are due 1 week from today, Tuesday, March 16th. For our witnesses, you have 45 days, if you would, to respond to any of those questions from me or from my colleagues. Thank you again for that. A couple of comments. I appreciated Professor Ghilarducci making it clear that the stock market is not the economy. Making the markets fair is important, but equally important is remembering that half the country doesn't have any stocks at all. Most Americans get their money from a paycheck. Growing those paychecks, not growing stock prices, is the most important thing we can actually do to improve Americans' families' lives. And when people's hard work pays off, the more they're able to put a little aside at the end of the month and invest for the future. We're never going to have fair markets or an economy that reaches its full potential until our economy and its rules reflect the dignity of work. With that, the hearing is adjourned. Thank you all so much.